Investors and traders, welcome to the channel Market Chart Pattern. Today is 2nd of May 2024. I hope everyone is having a great day. In this video, we are going to take a look at the key US markets. We will start by taking a look at the US dollar index. Then we will take a look at the bond markets through the eyes of the US 2-year Treasury note and then the long bond futures. We'll look at gold as well. And then we'll move into the stock indices, take a deeper dive. And if time permitting, we'll also take a quick look at Apple stock and also the Tesla stock. As always, this video is for educational purposes only and it is not a financial advice. So today, the most important chart from my perspective is this chart that we're looking at. Is the daily chart of the dollar index, because the dollar has done something today that is really important to take a look at. Now, just to give a little bit of a perspective for the dollar in this shorter term actually made a bottom around 18th of July. By shorter term, I mean going back last couple of year and a half actually, so from 2023. And then it formed a top around 3rd of October 2023. And then it formed another top where it was not able to take out this previous top of 3rd of October 2023, and it was a double top formation, right? And then it went and formed a low towards the end of 2023. Currencies, we'll do a video about it, but usually towards the end of the year, in the month of December, in the second half, usually currencies make big moves. Often they'll start or end a trend. So this is really something very specific to currencies actually. And what we have seen is a bottom come in, and then the US dollar rally into the 13th of February, does a correction in this move of this ABCD, moves higher right into this zone, which is actually highlighted by these two red lines. So there's a gap around here. It had left a gap, which is something not very commonly seen, but there is in fact a gap on this chart. And this is exactly where the price has gone into, and it's also the 1.618 expansion of this move here. This one's a little bit of a correction it had here. Long-time subscribers will know that we were watching for a possible retest of 107 level, but because of this gap, the chances are that it might not actually try to make an attempt towards 107, because there is a fair amount of resistance because of this gap around here, also 1.618 expansion. And the key thing for us to watch, which we had been watching, is that the dollar index began to find resistance. Then a bit it did find support on 26th of April, right from the 38.2% retracement of this swing. So this swing low to this swing high, and it did it in an ABCD formation, and because of that the market is actually sideways. And yesterday, when the Federal Reserve, the FOMC minutes came out, and when the chairman Powell, he was doing his speech, there was a lot of activity during that day. It just went and tested these high one more time, rejected higher prices, and actually closed lower. And the key thing that we are watching is that today, on the 2nd of May, it has in fact closed below the 38.2% retracement level. So this is really important, because what it means is that all of this was actually in fact a recovery high, where the market went sure enough above the 78.6% retracement, but just closed this gap. And it looks like the dollar index might have put in a high, which is likely to remain for quite some time. So let's see if we have this bigger ABCD completed around here. So we take this and we project it. So in fact, it did not. It was because of this ABCD. We were looking for 107 to be tested, but it came pretty close to 106.40, 106.80 is what we were looking at. But we had this fair amount of resistance, the open gap around here, which the market actually filled in yesterday. So closing below the 38.2% retracement, and if it does it on 2 consecutive daily basis, would mean that perhaps we have seen an important high coming in the dollar index, which is really important and significant for risky assets perhaps, and also for the precious metals, because with the dollar moving lower, we should see dollar denominated precious metals move higher. We'll take a look at the gold market as well. So market to market, some markets are quite specific, but it also means that if dollar index is moving lower than the currencies which are part of it, it's a basket of different currencies. For example, the euro being about 51% of it in terms of components, should begin to move higher, and so does the British pound, and the Japanese yen should get strengthened as well versus the US dollar. So it's really, really important what happened. And tomorrow is Friday, the week will close. We'll see how the week will close. And if we see a consecutive daily close, it will be closing 3 days lower, or in fact, if it's just able to close below the 38.2% retracement level for 2 consecutive daily basis, that will be significant as well, in my opinion. So let's just keep this chart in mind. Now we'll just move to the US Treasury yields. We'll take a look at the 2-year Treasury note, and we'll do that by taking a look at the yield chart. So what we see on the y-axis, these are yields. This is what the 2-year note is yielding currently, roughly around 4.88%. Now this chart is really important. It's very important in fact, because in my opinion, I did a video about it in which we had a look at that Federal Reserve really like to follow the 2-year Treasury note. So its yields when they are 5% or higher is something where the Fed is actually taking a note of it. So maybe I'll do another video about that because the video I did is maybe a year old now, and of course things have been updated, so I'll do another video about that. But what is important for us is really significant what happened over the course of past 2 days. So if you remember, we were looking for this is the 4.9, it's roughly 5%, and we were really watching for this 5% yield level on the 2-year Treasury note, and the market had just gone sideways for quite a while, and 5% is a pretty significant number as well, so from a psychological perspective as well. And we had this 78.6% retracement just sitting slightly above that. And also what we have is this is something which I had not drawn before, but this is, if you look at this blue, this is the ABCD one-to-one price projection, which was also completing around 5.037, and I believe the high has been 5.046. so the ABC really did its job pretty well. And if you look on the left hand side, there's some structural resistance around here as well. So if this happens to be a recovery high, so it's gonna be below this, there is a potential that in addition to having two confluence levels coming in, because the 78.6% retracement and this pattern formation of ABCD, whenever there is a confluence of two or more ratios or patterns coming together, is something we'll really pay close attention to, because those tend to be the stronger support or resistance levels depending upon the chart. In this for the yields, it happens to be a pretty strong resistance level. So in addition to that, there's a possibility that this is the left shoulder, this is the head, and this is the right shoulder formation, and we might have seen the high in yields for the US 2-year Treasury note for quite some time. There is a possibility for it, and of course there will be some resistance level in between which we'll take a note of. But if there is going to be another one-to-one price projection ABCD, that actually calls the yields on the 2-year note, believe it or not, to go down to as low as 3.9%. This is where we have the 78.6% retracement, you know, just the way it retraced this ABCD move right to the 78.6% retracement, this black ABCD, which I've not labeled yet with a question mark, actually points down to around 3.9%. And this is where we also have the 78.6% retracement from these lows. I've taken this low, I've not taken the exact low right here. It's just because arbitrarily this is where the price tested 2 times the rejected lower yields, and the yields began to rise. So that's why I've taken this level. But we have a confluence of the pattern and 78.6% retracement coming to the downside right here. So this is something which we'll be watching, and I personally believe that there's a good chance over the course of a few months perhaps we might actually get there. But in between we'll have to watch for certain resistance level, and I think our first clue will come if the yields will close below the 4.7% level on the 2-year treasury note, because that's the 38.2% retracement from these lows to this high right at the ABCD, and 78.6% retracement. So that's going to give us the clues. And of course we have this nice trend line here as well. The trend line would possibly be broken much earlier, and this red line we see is some structural which was resistance in the past but could become support. So we'll have a break of number of these things, the structural support, the trend line, plus if the 38.2% retracement around the 4.7% is also broken to the downside, then the chances are that we might in fact be in this ABCD price pattern down below. So the yields on the 2-year treasury note possibly may even go to 3.9%. Hard to visualize that, but again, this is what the pattern is calling for, so we'll have to wait and see. All right, so now we'll take a look at the longer term, the long bond futures. This is the 30-year bond futures. Here, if you guys remember, the long-term subscribers will know, the new subscribers, welcome to the channel. We had been watching for this price point around 114 to 113 in the 30-year treasury note for a possible good bottom to come in. And yeah, there is a chance that that pattern might have failed, but it still remains above the 78.6% retracement. And what we have seen over the course of past few trading days, this week especially, this level is being held. So there's potential for this to be a double bottom around here as well, especially if the price begins to close above the 20-day moving average. Now the key thing will be if it is able to get above and close above the we'll roughly call it 116 level, because that will be closing above the 38.2% retracement of this swing here. And there's also several swings right there, but if we just take this swing, which is this bigger swing around here, then about 116 is going to be the key level to watch. If there's going to be a failure, it would be a failure or rejection of the price moving higher from the previous attempt of from 19th of April, which was also at the 38.2% retracement. So that symmetry would still be working in the marketplace. But if it's able to break above that, that's going to be an early sign that things perhaps are changing a little bit. So what we have seen in terms of the 2-year treasury note, and what we're looking at the longer term, you know, they will begin to come in line. The only thing is that the 30-year treasury note chart is on the price basis. So what we see is the prices around here, so which means price move up, yields go down. So another interesting information to watch for. Now, not everyone looks at the bond futures, so we'll also take a look at the TLT. Now this is the ETF. It is the iShares 20+ year treasury bond ETF. So it constitutes of treasury bonds which are of the duration 20 years and above, so fairly longer term. And here we also see something really interesting in terms of the pattern formation. We have this 1-to-1 price projection ABCD completed right here. The market went a little bit lower and now it's backing up. So it's very similar to what we see on the 30-year long bond futures chart. And I believe the price was very close to the 61.8% retracement. Let me actually draw it around here. So yeah, it went a little bit lower as well. And now there's a possibility of an inverse head and shoulder formation. But again, the price needs to close above the 38.2% retracement. So here we go. In fact, two things to watch for. Let me actually have to bring it a little bit higher around here. Take this one, the CD swing. Okay, so that should bring us here. Let me actually get rid of this one. Okay, so that's the 92.30 level. That will be an early indication, because from a market symmetry perspective, we had a previous rally, the biggest rally that we have seen, about this much. This one was less than that. So if we are able to break above that, that will be break of the symmetry, breaking above the 38.2% retracement. That's why I've written watch for 92.40 level, because that will give us the clues. And it could mean that this market, the bond markets, might begin to rally for multi weeks and multi months, but still will be in a bear market if you go back to March of 2020. So that we should always keep in perspective, but it could be a massive rally within a bear market. That possibility remains there, but we are watching this pattern, and I think we are pretty much there, or very close to the completion of this pattern, just waiting for the momentum to improve. And of course, tomorrow we have the non-farm payrolls and some other unemployment data coming out. That's going to be something really important. So this week has been massive in terms of economic data and FOMC coming out. So we'll get a much better picture towards the close of the trading day. Okay, so with that done, let's begin to take a look at the gold market. So here we go. This is a daily chart of the COMEX gold. This is not the spot gold. This is COMEX gold. We have seen gold pull back from its highs by a fair amount. But if you look at how high it has been since February, this correction is kind of minor. Now, the interesting thing is that we had seen the chart of the dollar index earlier on, and dollar index closed lower. So the dollar closed lower against a basket of currencies. And the interesting part is the gold was also weaker today. So the gold actually closed lower as well, in fact negative where it opened. So it closed lower to where it opened, and it formed an inside bar to the candle of 1st of May. So in my opinion, we'll just go back to this 15 minutes chart. This is the pattern that we had watched, where we were looking, where we because based on this pattern formation, it's in the older videos, really strong resistance coming around this level of 2360 to 2365, because of this ABCD one-to-one price projection right at the 38.2% retracement. In my opinion, the COMEX gold needs to get above the 2365, 2370 level to begin to climb higher again. As long as it remains below that, and then the chances for a correction, going back to the daily chart, right to this 38.2% level, they remain there. Now let's see if we'll have a one-to-one price projection thereabouts in that region. Should the market do that, and in fact that could, the one-to-one price projection in fact moves a little bit lower, but 2275 is a possibility, because I see 38.2% retracement from these lows to these highs. That remains a possibility. And if we try to find some confluence level and take a retracement from here, then let's do 50%. It's already done, it's 50%. So that will be very close to the 61.8%. So we'll have a confluence of two ratios coming together. Over the weekend, I'll do more work, but the the non-farm payroll data is there tomorrow. The momentum is also beginning to weaken a little bit, because the 8-period moving average is below the 20 period moving average. So that's something we need to be aware of. So again, that possibility to 2275 remains there because the 38.2% retracement, and we'll see how the gold will trade tomorrow because of FOMC. There's going to be a fair amount of volatility. Okay, with that, now we begin to move into the US stock indices. So we'll take a look at the SPX, which is the cash market for S&P 500. So this is the 1st of May when the FOMC happened. A very interesting day because you look, there was a fair amount of rally, probably because of some comments made by the chairman Powell, and then the sellers came in and they closed it lower. Now the interesting thing is that today the market actually rejected lower price and moved higher and closed higher as well. So that's a micro double bottom around here because the price is rejecting lower prices. This is something that we should make a note of. Now, when this day happened on the 30th of April, we were looking at a possibility by taking a look at the volume. Let me bring it back, whether this might just be a gap fill. But the volume on this down move was actually higher than this. This is the gap day when the gap happened. So the chances were perhaps it was none, and also because of this candle formation is known as Moriboso, it's just usually a continuation move. So the next day we saw the market closing lower to the previous day, and today we see it being reversed. And one of the things is that, let me actually move to the 60-minute chart. So here we go. Let me blow it up. So what we can see is here when the market retraced, it retraced to about 61.8% and it closed higher and then moved higher, and this is the price action for today. This is the cash market, of course, and here in the market you look at the in number of hours. 1, 2, 3, 4, 5, 6, 7, 8. For 8 hours and more, actually, it just remained. It was testing this 61.8%, but always rejecting. Excuse me, this is 78.6% retracement from this low to the highs. This high, this low to this high, and the market was not able to close lower. So it's pretty strong support level. And if we just draw a trend line from this low to this low, and we just draw a channel, it looks like this market is actually moving in a channel formation, and the chances are that this 1-to-1 price projection might actually get completed. And of course we have this 61.8% retracement coming around 5150 level, and the ABCD completing around 5180. Now moving back to the daily chart, this is initially what we were looking for, 5150 being the 61.8% retracement. So the chances are that that pattern might still be valid because the market has not taken out these lows of 25th of April, and it could actually rally up again, as we have seen on the 60-minute chart, and go right up to the 61.8% retracement, which is going to be pretty good for the bulls because it means that the market was able to do a pretty deep retracement. And of course, the 3 scenarios that we had discussed, there's one possibility that the 19th of April low might actually be a really important low, and the market might go and make new highs as well. So that possibility also remains, but the key will be 5150, which is the 61.8% retracement level. Now let's move down to the daily chart of S&P 500 E-mini futures. So here the picture is a little bit different because this market trades throughout the day with a few hours where it gets closed. This level of 50.38 is really clearly support because price has rejected lower prices for 2 consecutive days, so it's a micro double bottom. And here where the market had bottom on the 25th of April was the 61.8% retracement. Let me actually go down to the 60%, maybe it's a little bit the daily chart. So what we can see is, look, the market is refusing this price level is important, and then we'll have a series of higher lows. So very similar to the cash market, this market is also moving in a channel formation, which means that, going back to the daily chart, that this level of 51.95, which is 61.8% retracement, we might still be able to actually get there. That remains a possibility, and then we'll evaluate how the market is going to be. It's a fair amount of resistance from structure here around this level as well, so it's a really key level to watch, 51.95. A quick look into the NASDAQ 100 E-mini futures, similar kind of a pattern formation, because the market actually formed a micro double bottom on 2 consecutive daily closing basis and rejected lower prices around here. So the chances are it might actually go and also move into this zone and perhaps even test this 18,000 to 18,100 level, which is 61.8% retracement. So this is what we are watching in terms of how the market might unfold. What we see around here, this big arrow, for new subscribers, please watch the video which is done over the weekend. We were just evaluating different kind of possibilities for corrections which have taken place in the past. So I'll just have a very quick look to show you guys what we were actually trying to do. And here, if you look at in this bull run since October of 2022, we have had the biggest correction being around 13%. So in percentage terms, if we just take this biggest move, then this is the level we could get. We were just trying to evaluate that. So apologies, the video is getting pretty long, so I'll just shorten the video here. Thank you very much for watching the video, and if you like our analysis, please give it a thumbs up. And if you like how we do the technical analysis on the channel using pattern recognition, Fibonacci ratios, retracement, expansions, and projections, then please do think about subscribing to the channel. And if you do, then please also hit that bell icon button. That way you will know when the new videos are posted, so you will not miss on anything. So thank you very much. Good luck, good trading, and speak soon.